From here, you will understand not just how the world's smartest capital moves across the real estate, credit, and defense asset classes, three of the most misunderstood but powerful verticals for asymmetric capital deployment, but also why stacking them together create a portfolio with cash flow, durability, and power. That is, we are going deal by deal, dissecting each one the way institutional investors and elite family offices do, with precision, narrative alignment, and risk weighted leverage. So let's break it down. Now, starting with the real estate deal, and this is the deal snapshot. The type here: last mile logistics hub. The market: Charlotte. That's the NC outskirt. Purchase price $22 million. Equity required $6.5 million. Cap rate current 6.2%. Anchor tenant mid-sized medical logistics group with 7-year lease. Now, why this deal works? First, demographic arbitrage. Charlotte's population outflow from expensive coastal metros drives demand. Second, zoning moat. Limited industrial permit means scarcity premium. Third, sustainability upside. 600K capex converts to solar given tax credit plus ESG boost. Fourth, stabilized cash flow. 1.5 million net operating income with contractual rent bumps. The optionality here: refi at year 3, returns approximately 80% equity, potential to stock a sale leaseback structure for additional spread play. The long term here: sell to REIT, real estate investment trust, or pension with baked in ESG narrative. Now, this isn't just about yield, it is about frictionless liquidity at exit. Institutions are thirsty for stabilized ESG compliant industrial real estate. Now, to the private credit deal, and this is the deal snapshot. The borrower here is an energy infrastructure startup. The loan size 15 million senior secured. Interest 11% fixed, paid quarterly. Term 36 months. Collateral here: grid battery equipment plus receivables. The covenant: monthly revenue test with debt coverage ratio 1.8x. The warrants here: 3% kicker in equity. Now, why does this deal work? First, cash flow first. Revenue generating startup, not pre-revenue. Second, asset backed. That is hard collateral plus enforceable contracts. Third, high yield, low volatility. 11% fixed plus warrant is equity like return with credit risk. Fourth, mission aligned sector. Renewable storage. That is, funds here have ESG mandates to fulfill. Optionality here: secondary market sell note at discount with 24 months left, which equals IRR spike. Equity upside: warrants convert if company hits Series B milestone. Downside protected: liquidate battery assets at 70 to 80% of value. Smart capital is where you buy cash flow, but also steal exposure to equity, all without carrying venture level risk. Now, this is the defense deal, and this is the snapshot. The target: minority stake in predictive maintenance AI company for aerospace. Valuation: 85 million post money. Investment: 5 million for 5.88%. Revenue: 8 million ARR. All business to government. The customer here: US Department of Defense plus NATO partners. The moat: proprietary machine learning trained on military specific asset data set. Now, why this deal works? First, government embedded. 3-year DoD contract means predictable cash flow. Second, niche tech equals monopoly dynamics. No civilian overlap equals no new entrance. Third, acquisition ready. Lockheed, Raytheon, and Boeing actively acquiring in this category. Fourth, dual use pathways. Same tech can be adapted for commercial airlines, which equals growth engine. The optionality here: convertible structure. If not acquired in 24 months, preferred terms activate. Follow on right. Option to double down at next raise. IPO defense angle. Now, defense plus AI narrative is investor candy in later stage IPO cycles. Defense is the power sector, protected contract, geopolitical tailwinds, and exit ready by default. Now, what happens when you don't just do these deals in isolation, but layer them into a symphony capital stack? First, real estate equals yield plus stability. This provides cash flow foundation and capital preservation anchor. Second, credit, which equals high yield plus downside control. Here, it injects short-term liquidity plus mid-term optionality. Defense equals scalable upside plus political moat. This creates the hockey stick in the portfolio with natural bias. Now, the capital synergy here, credit repayment recycle into follow on defense investment. Real estate equity refi can be used for warrant buyout. Defense equity IPO proceeds repositioned into new real assets. These aren't just individual deals. This is capital as a system. Hedge funds, sovereigns, and dynasties, this is how they think. Now, the best investors don't just chase trends, they design portfolios like infrastructure, real estate, credit, defense. Different rhythms, different rules. But when structured correctly, they become a self sustaining flywheel of wealth, influence, and leverage. Learn to think in deals and then learn to stack those deals into systems. That is how the next generation of billionaires will be built. Now, with all these, they should convince you to subscribe for more.